Hello, I am Rodney Clayton, Portfolio Manager and Senior Research Analyst on the Global Listed Infrastructure team at Duff & Phelps. Today, I'm going to walk through three key trends we are seeing in the energy infrastructure market. The first trend is underinvestment in energy infrastructure. Because global energy supply and demand centers are increasingly separated, energy infrastructure assets have become more critical than ever. If energy-starved parts of the world are to benefit from an abundance of resources elsewhere, there's a clear need for more pipelines, export terminals for LNG, crude oil, and natural gas liquids, refineries, power generation, and storage. This need has been highlighted by the Russia-Ukraine war, which suddenly stripped Europe of its top energy supplier and now has forced them to scramble to secure supplies from other corners of the globe. Europe will now need to spend hundreds of billions of dollars on the infrastructure required to import conventional energy supplies in the near term, while also continuing to fund its net zero ambitions over the long term. Additionally, the value of existing assets, the proverbial steel in the ground, is going up as it has become increasingly difficult to build new infrastructure due to capital constraints, permitting challenges, and of course, environmental opposition. Collectively, these factors are leading to higher prices for the energy sources that are so vital for modern life. This leads to our second trend, energy companies returning more cash to shareholders. Higher oil and gas prices, combined with a more challenging backdrop for capital spending, has led to energy companies generating record amounts of free cash flow. With debt at historically low levels for the sector, companies are returning more and more of this cash to shareholders in the form of both dividends and share repurchases. For example, midstream is one of the only corners of the equity market with yields in excess of U.S. Treasuries. Another example, the two largest U.S. independent refiners have collectively reduced their share count by over 20% just over the past 18 months. This enhanced financial flexibility will enable energy companies to better weather the next energy cycle downturn, whenever that might be. We think this is a durable trend that supports the investment case for energy infrastructure equities. Our final trend is the broadening of the energy transition. You may be aware that the deployment of solar and wind generation is growing exponentially faster than fossil fuels in developed economies. But there are two things you might not know about the energy transition. One is that as we introduce more renewable power sources into the electric grid, it actually creates the need for more dispatchable power supplies for the times when renewables can't meet demand. For example, when the sun isn't shining or the wind isn't blowing. Natural gas is an obvious choice here, given that it is abundant and relatively cheap. It can be transported efficiently on existing pipelines or shipped across the ocean when converted to LNG. Furthermore, modern gas turbines are also capable of running on hydrogen if and when supplies become widely available, making these investments relevant for both the fuels of today and of the future. Second is that many conventional oil and gas companies are investing heavily in energy transition technologies. These incumbents also typically have superior technical expertise and better access to capital than newer companies. So in several cases, we are seeing the best energy transition investment opportunities, not in unprofitable startups, but in many well-established energy and power companies that have been around for ages. Thank you for your time today. We look forward to keeping you updated on the energy infrastructure market going forward. Please visit our website for more information.